Quantum computing is quickly becoming one of the most exciting frontier technologies, and many investors believe it could be the next mega trend after artificial intelligence. And right in the center of all that hype is IonQ, a company that many see as critical for future national security and advanced computing applications. But while enthusiasm is rising, the stock itself has hit some turbulence recently. Today, we're going to break down what's actually going on, what the numbers are telling us, and whether Ion could realistically be a buying opportunity heading into 2026. Let's start with the latest pressure on the stock. Over the past month, IonQ shares have been weighed down by two major events. First, Amazon exited its entire position in the company. That alone triggered a wave of negative sentiment simply because a big name investor stepping away always raises questions. Then, another large shareholder sold 1.4 million shares, which added fuel to the short term selling. When big holders sell, momentum weakens regardless of fundamentals. But here's where things get interesting. Even with that negative sentiment, IonQ actually raised its expectations for next year. The company increased its 2025 revenue outlook to above $110 million, dollars, up from the previous estimate of 100 million. So the business outlook improved while the stock price fell. That disconnect is worth paying attention to. Now let's look at IonQ's position in the broader quantum industry. It is still extremely early for quantum computing. None of these companies are generating meaningful commercial revenue yet. Almost all revenue across the sector comes from government programs, research institutions, and development partnerships. But even in this early stage, IonQ stands out. The company has generated around $79.8 million in revenue, which is the highest among quantum peers. And unlike several competitors, including Rigetti, whose revenue has been declining, IonQ is consistently showing growth. That tells us something important. Even in a research driven environment, IonQ is demonstrating traction and institutions are willing to pay for its progress. However, the real breakthrough for the industry will come when quantum computing becomes stable enough for commercial use. That's when enterprise customers, cybersecurity firms, biotech labs, and AI companies could start adopting quantum for real world applications. That shift could unlock massive value, but we're not there yet. Now, let's talk about something absolutely critical for a company at this stage: the balance sheet. Since IonQ isn't profitable and won't be for several years, cash runway becomes a central part of the investment thesis. The company used the surge in quantum stock prices over the last 1 to 2 years to raise capital at high valuations. So that was a smart move. As a result, IonQ now holds about $346 million in cash and equivalents. That's close to its highest level ever, even compared to 2021 when it briefly had around 400 million. And since then, the company has invested years into R&D, improving qubit performance, error correction, and hardware development. Having almost the same cash level after all that progress is impressive, but now we need to look at the other side: cash burn. Over the most recent 12 months, IonQ recorded free cash outflow of $259 million. That is more than double the 124 million it burned the year before. Before that, the burn was 93 million. Before that, 54 million. So the cash outflow is accelerating rapidly. If IonQ keeps spending at this pace, its $346 million balance gives it just over 1 year of runway. And if expenses rise again, the runway shrinks even faster. At that point, the company either needs to raise more capital or slow down development. Raising capital is possible only if investor enthusiasm remains strong. Slowing down development, on the other hand, would mean fewer hires, fewer researchers, and slower progress. And in a race where multiple companies are pushing for the same breakthroughs, slowing down could be risky. So the big question is IonQ a buy for 2026? Here's how I look at it. On the positive side, IonQ is the revenue leader in its space. It's one of the only companies showing consistent growth, and it's operating in a market with enormous long term potential. The company also has substantial cash today, which gives it room to keep building, but the risks are significant. Cash burn is rising quickly, the runway is shortening, dilution is likely, and most importantly, the valuation is incredibly hard to calculate because the industry hasn't reached commercial adoption yet. That makes the range of outcomes extremely wide, from breakthrough success to extended delays or even structural challenges. For investors who want predictable cash flow, clear business models, or reliable valuation metrics, IonQ is not at that stage. The uncertainty is simply too high. For that reason, I would classify the stock as a hold rather than a buy. However, some investors take a different approach. They're looking for asymmetric opportunities, situations where a small investment could potentially 10 times 50 times or even 100 times if the company becomes a leader in a world changing technology. Quantum computing absolutely has that kind of upside if it reaches the commercial breakthrough everyone is waiting for. For those investors, a small speculative position makes sense as long as they understand the risks. So the bottom line is this: IonQ is one of the most advanced quantum computing companies today, but the road ahead is long, expensive, and filled with uncertainty. If you want predictable value, this isn't the place. If you want high risk, high reward potential, it may be worth keeping on your radar. But for now, heading into 2026, this looks like a hold, not a buy.